Facebook Live. Sorry about the technical difficulties we've been having with our Facebook group, but right now we are streaming. So today we are going to be talking about part two of real estate terminology that one need to know. So last week we spoke about some of the words that Tom and I we discussed some of the definitions in real estate language, and this time we're going to be continuing with part two. And right now we have George who's going to be joining us, and he is going to be sharing his knowledge, what he knows from his SDR Randalls. And without further ado, I'm going to pass the mic off to Tom.
Hey, everybody. Good afternoon. Sorry again for all the technical difficulties. There was a little bit of a delay because Facebook changed some stuff out of the blue. So we are a little late, but nonetheless live. So, welcome everybody to a live. Good to come to you on a Thursday night to talk about some really important stuff today. Today, we are talking about real estate terms that you need to know. There are some terminology that is used in the real estate that when you hear them, you may not even recognize them. When I started, some of these terms that they threw like cash on cash. They said cap rate. Many of these I didn't have a clue, but today we are going to take care of all that for you. So next time you talk to a broker or a listing agent, you would not be out in the dark. So without further ado, George Salas, the king of SDR. Let's go.
What's up, everybody? Man, thanks for the warm intro, fellas. So yeah, just doing fantastic here, gentlemen. And I was at phone launch last week, so I wasn't able to attend. But we're back live, just like every Thursday. So happy to be here. I haven't chatted with you fellas in a couple of weeks. But every Thursday here, we are bringing in different topics in real estate where we just discuss things between us, like we're just talking to each other, right? And I think we started doing this. You guys have been running this for a while, and I started joining this a couple months ago. So I'm just want to let you know that I'm having a great time here. I'm actually learning about other asset classes with you. So, but again, for everybody listening out there, my name is George Salas. I'm a short-term rental operator. I specialize in creating lifestyle assets, and these are median luxury properties that we buy, median real estate that we turn into luxury via creative finance in Texas and several other states. I operate a fund. I operate about $9 million in real estate, single-family, short-term rental assets, and as a team, my partner and I, we have 47 short-term rental homes together in many, many, many cities. So I've been doing this business. I think I launched my first short-term rental, about 6 years ago, and I have launched over 110 now, in between my clients, my strategic partners, and then ours. We used to do a lot of our short-term rentals when we started as a short-term rental arbitrage. We would rent these properties and launch them out. But today we focus on purchasing, because real estate is about buying and getting the benefits, which are appreciation, depreciation, and of course, cash flow. So I'm ready to get started, fellas. Let's chat some real estate. How about that?
Yeah, let's talk about some words, because last time, what did we speak about there, Tom? We spoke about NOI,
We
right?
spoke
We
about
spoke
cap
about
rate. That
mhm,
was the first one we started with, cap rate.
cap rate and capital expenditures, right? So we spoke about
Yep.
that. So this time, what do you want to do? You want to just start with something called occupancy rate?
Yeah, that's a great one to start
Sure.
with, actually. Occupancy rate.
Yeah,
So
let's
any
start. Let's
property.
go for it.
Yeah. So occupancy, guys, what is occupancy? Occupancy is simply the number of people occupying a property in terms of a percentage. So if there is 100 units and 98 apartments are full, that means the occupancy is 98 and the vacancy is 2%. As simple as that. Now, what about you guys? Guys, is there a more professional definition to that?
The only thing I can think of occupancy when I hear about occupancy rate is the percentage. There are two kinds, right? One is just a regular occupancy rate, and one is the effective occupancy rate. So effective basically just means a fancy term about, which means like net occupancy rate. That's what, I kind of get out of it. What about you, George? What do you got?
Yeah, for us in the short-term rental space, occupancy rate is just referred, because there's each house has their own occupancy rate, like compared to multifamily. You guys are talking about the entire building's occupancy rate, right? Which actually units of the 100 units are have long-term leases. For us is which days of the month are actually rented, right? So in our industry, a good occupancy rate for the types of properties we specialize in, which are going to be 4 bedrooms and up, is anywhere between 50 to 70%, and then it varies, based on seasonality. So in the multifamily space or other asset classes, occupancy rate is more of a long term thing, right? So in short term rentals is actually maximizing your revenue through occupancy rate, because you could
Right.
be 100% occupied and make less money than a property that I have while I am 60% occupied, right? And the reason for that is because in our world of short-term rentals, right, occupancy is one of the components. It's not the main component of a successful short-term rental business, right? Occupancy is, you got to maximize it, and there's a way to maximize it, and it's through pricing, dynamic pricing strategy. And then I'm not going to talk about pricing strategy because that's probably one of the next terms, but that's in realm what I think of when I think of occupancy rates. I want to be as much as I can, as high of occupancy rates as I can get without deteriorating and lowering my price too much. So I got to understand the market to get my occupancy rate higher. While in other asset classes, you've got to do great marketing. You've got to create a property that's beautiful to get that occupancy rates higher. Maybe have competitive rates, right? So a little bit different there. So I wanted to make a point on that, on the differences in your game, multifamily, right? Dental offices versus or commercial versus short-term rentals.
For sure, you got a great point because it's kind of interesting because in your short-term rental world, it's like 50 to 70%. That's what you're targeting. But in multifamily, we want to be like in the minimum, I would say in the 90s, like low
Yeah.
90s.
Yeah.
So low 90s to high 90s, that's a really, really great number. But however, when it comes to retail strip mall plazas, the occupancy rate, it's great if it's 100%. However, if you're going to be selling it, if I'm a buyer in one of those retail shops, I kind of want to see like maybe like one or two or maybe three stores like kind of open, just because there is some meat on the bone, right? Because if you like have 100% in a strip mall plaza, which may be great for like cash flow, but then there's really not much upside because those leases are kind of fixed. So I kind of would like to see if there was a 10, shop plaza and maybe 88 of them are occupied. I would kind of like prefer, like personally would have to, would like to see like two of them are empty,
Empty. Hmm.
right?
Beautiful.
And then
Yeah.
of course
It
in a
can
great
vary,
area
right?
and then getting
It
great
varies
tenants.
by asset class, right?
Exactly. Exactly.
And one of the things why occupancy is very important is because when you go to get a loan or refinance a property, one of the first questions they ask is what is the occupancy rate? They don't want a loan on something that is 70% or even 80%. They want to,
Right.
you're able to get more money from the bank if you have a higher occupancy because that means the property is performing really well and there is opportunity to increase rents.
Beautiful. Yeah.
Great. Let's jump to the next one. The next one, this is like in everybody's realm, right? Expense ratio.
Beautiful. I
So
love
when
that.
we say expense ratio, I mean the first thing I think of is what is the gross, what is the income coming in, and what is the expense. So pretty much that's what I think. Like, what is the expense ratio? I'll let you guys chime in on it a little bit.
Yeah, George, you want to go?
Yeah. So for us, expense ratio, when I think of expense ratio, I think of operating expense ratio, right? So
Mm-hmm.
in our world, again, it's different, right? The operating expense ratios, a good operating expense ratio in short-term rentals is going to be 45%, right? So now that includes all of your expenses except for your mortgage payments, right? So operating expenses include all of our expenses which are going to be cleaning and you know utilities and management, property management fees, et cetera, et cetera. So we want to really focus in our world to keep an operating expense ratio of 45%. Now, there
Hmm.
are competitors out there that have way higher, and there are properties out there also that could get up higher. Just depends how old they are, right? So the older the property, the more maintenance costs you're going to have, right? So to me, when I think of operating expense ratio, I want to keep it as low as I can. So obviously to keep more of that bottom line, right? So yeah, let's add some cooler points, fellas.
It kind
Yeah,
of
let's
depends
go.
on if I'm underwriting the deal. I like to keep the expense ratio a little bit higher, just because of the fact that you want to be a little bit conservative for some unforeseen like expenses that may pop up. I'm not sure. Tom, do you agree with that?
Yeah, totally. And also, yeah, absolutely. You want to keep it at a higher rate, so you will have some good surprises coming when you start leasing the property, right? The other reason why expense ratio is important is because at the end of the day, you're running this real estate operation, so you can get some profits, you can get some cash flow, right? So the lower the expense ratio, your profits go up. The higher the
Hmm.
expense ratio, your profit comes down. So always you want to minimize your expenses as much as possible. And that simply means more cash in the pocket. Some of the properties are so mismanaged today, all it takes is just adjusting a little bit of the expenses and managing them properly, and the property would be profitable. We see so many of these OMs and that get sent to us, and by looking at the numbers, you can see that many of these properties have a super high expense ratio
Hmm.
because so many of these is mismanaged, and if you're able to manage it, that means more money in the money in your pocket, means more net operating income. The property value goes up.
For sure, for sure.
Beautiful, beautiful.
Let's jump on to the next one. It's replacement cost.
When I think of
Let's go.
replacement cost,
Yeah.
I think of what would it cost my insurance company or us to replace it as if it was new, right? So when I look for an insurance policy, I want my insurance policy to have always replacement costs, because if you don't have replacement costs, then
Hmm.
the insurance policy will pay you for what's the opposite of that? Do you remember the actual name? I can't remember. I can't recall the term for that.
Yeah, it's like pretty much like what is going to be the
Balance.
cost to replace that unit, or in your case, that home, right? That short-term rental home in today's market.
Yeah, correct. So if
So,
today's dollars, it costs $40,000 to replace their, to do a full renovation inside the insurance company. Let's say the property, there's a fire or something. The insurance company will give you that. Or, in terms, when I think of replacement costs, I'm always thinking like insurance,
of
right? Like,
course.
how much are they going to give me if something goes wrong?
Or
Yeah.
even the fact that, let's say, if you were to build something like right next door,
Yeah, that's
like
that's
brand,
that's
brand new.
exactly yeah, that's exactly what I was thinking. Like the other day, I saw some a property that was listed, and you keep seeing this, and it's in an amazing location. It was built. It's in River Oaks. So George and Noel probably know River Oaks is like the top area in Houston. Yeah, it's like the best. So, and the first thing they had in the OM is irreplaceable asset. What does that mean? So this building was built in 1985 or something like that. So what they're simply saying is that they've got a building in a perfect location, and if you were to build
Mm.
that building today, that's going to cost you probably three times of what it cost them to make, even four times. So basically, what they're saying is you're going to pick up an asset for cheap than what it's going to cost you to build the same thing today.
And so that's exactly what we do too when we look at multifamily and we look at different apartment complexes when we are looking for investments. If we find a unit that, let's say, it's 100,000 to 140,000 per door on an average, and let's say if it's a 20 unit or a 30 unit, doesn't really matter on the number of units. But if it's 100 to 140,000 dollars a door, we already know like the replacement cost today would be anywhere almost double that, or maybe even more. Again, depending on the location. So as long as we can find a deal that's way below replacement cost, and of course the location is great, it's a good asset to look into. So that's pretty much, like in the multifamily world, our definition of replacement cost. Again, it can be applied to what George said, basically about insurances, because a lot of times these insurances, they look at the dwelling and they look at what is it going to be in case there was a fire, if they have to replace that property. So pretty much anything to do to replace the current existing structure. That's what it means.
Absolutely.
Um, yeah. So guys, I think what do we have so far? Four. Let's do one. Let's do a couple more. What do you say?
Yeah.
Yeah. Okay. So one I really love is called debt ratio. So
George, did you want
basically,
to
yeah,
hit that, George? Or Noel, you're an expert
yeah.
in that.
I'll probably just start with it, and then you guys
Yeah.
can chime in.
Yeah,
Pretty
go
much,
ahead.
that's the total debt. What the place owes, right? Like, let's say we buy something, or even a business or anything, and then the total assets to back up the debt, and that's what's called the debt ratio. So let's put it this way: the higher the debt ratio, the more chances of that property or that business to default, right?
Yeah.
So let's say, like in your case, like, basically we are talking about over leveraging, right? So Tom, what do you have to say about that part? Like,
So you're
how does
so
it
basically you're talking about loan to value, right?
sort of, yes, yes.
Yeah. So loan to value, guys. I mean, when you go to the bank's going to be like, "Hey, you think you're going to be like, hey, this business is worth this building is $5 million." The bank's like, "Yeah, that's $5 million, but we'll give you only we can loan you up to 80% of the 5 million, which is what $4 million,
Right.
right? So that is the debt that you're going to take on that property is $4 million, which is 80% of the purchase price. Let's say for some reason there was a bad recession that lasted for a long time, and the property value dropped down to 3 million, right? So now you're sitting on a property that you owe 4 million, and it's only worth 3 million. So that's what is called as over leveraging. Some people go and get all the money they can from the bank, and then they just use it
Hmm.
for management, and they just don't spend it wisely, and as a result, when the value drops for any reason, or the occupancy drops, that could be a big problem for that asset. And that's why you always want to be very sensible when you go and get money from the bank. Just because the bank says, hey, we'll give you 80%, don't mean you have to take all the 80%. You could be happy with 70%. For example, Noel, in that Alabama deal that we did, what
Yeah.
was the percentage? What was the loan to value
Ooh,
percentage on that?
50%.
Like, yeah, 50 or 55% or something. I mean,
Right.
in that one we should have taken a little bit more probably, but that was super conservative. But one thing is for sure is that we'll never lose that property
Hmm.
ever, right?
Because that's where that LTV, like you were talking about, and the debt ratio comes in hand to hand, right? Because now we have a lot of equity, a lot of the property value that's going to back up that loan, which is why it's always safe to be in that kind of position.
Yeah.
So the downside is, everybody's got to cough up more for the down payment.
Yeah.
The good part is,
And
like,
the returns go down as a result too.
yes,
Yeah, that's another downside of that. Your
but it's
your
safer.
return on the investment goes down,
So if we talk
because
about that ratio, fellas,
Yeah.
what are we at cash on cash right there? Maybe like create a comparison. What happens to
yeah,
the cash
it's
on cash?
that's a great segue.
Even your loan constant or interest, the interest amount per year. there's different factors in there. We can get a little nitty gritty that I love this stuff.
Let's switch gears to what you just said, cash on cash. I love that. Let's talk about that. That's the next one on my list anyway. So
Beautiful. Can I
let's
start
go.
off? Let's do it.
Yes, it's all yours. The floor is
Yeah, go
yours.
ahead.
So for when we invest in short-term rentals, there's one way, right? And obviously we want to be, de-risked as much as we can, right? So for a lot of people when they get started, they want to go put as least as low as possible down, right? So when you're putting less down payment, but don't have a cushion of built-in equity, and
Hmm.
you're depending on market conditions, you're doing a rehab or fix and flip or even a long-term rental, right? You're kind of stuck there, right? So if you have a 10-year lease on a commercial building, and it's a guaranteed triple net, you have a little bit more of a safety cushion, even if you have a higher debt ratio, right? So, or loan to value. Now,
Right.
for example, there's a short-term rental, right? The only time where we get we typically go on our loan to value or debt ratio, right? About 70% to 75%. But as we build portfolios, right? As we are building our portfolio, we want to spread the risk. And how we spread the risk is we spread the type of acquisition we do, right? So for example, and it's harder to do in multifamily, right? Because it's one big building. In short-term rentals, you get a lot of smaller homes, $500,000 a property, right? So for us, as we build this portfolio, we want to keep, as long as we keep the entire portfolio at 70 to 75, that's golden for us. In some properties, we're going to go in there and purchase a value add property that's like 50 cents on the dollar. So we renovate it, we do this and that, right? Maybe we'll be at 60, 65. That's a way to de-risk our investments in our portfolio and grow it at a nice
Cool.
debt ratio. Then we're going to go in there and buy a rent ready. Rent readies are not going to be, right? You're not going to have any built-in equity, right? You'll have 30, 35% in a value add, maybe 40%, but these rent ready houses will have zero equity. So what happens is we bring some cash in our portfolio to buy this value adds. It requires the most effort, right? But it creates better returns on the exit, right? Then we come in and do this rent ready properties in our portfolio, right? And these rent readies create immediate cash flow. We still have to put more money down, which lowers the returns, but because we have to put 25% down instead of maybe 15% down or 20% down, by the time we refinance, we might be at 0% down by right when we do value adds, right? So, and then we come in and do creative finance. And creative finance could be anywhere between 80% to 85% LTV or debt ratio. So, for those out there just learning about these types of investments and how to deleverage the risk of a portfolio in a mixture of all of them, right? You create the best cash on cash return when you have a combination of strategies. One that's higher cash flow, like creative finance or rent readies are going to be higher cash flow because we're going to put creative finance, we're going to buy properties that are nice. We're going to select them, owner finance, sub two, right? So the cash on cash of that particular investment is way higher. Cash on cash meaning how much cash am I putting in year one versus pulling out. So if I'm buying a sub two and between staging, down payment, and closing costs in renovation, I'm spending $150,000 and I net $37,500 for year one. My cash on cash is 25%. So I put in 150, I get 37,500, and all I do is divide the amount that I put in versus how much I got out at the end of the year. That's what cash on cash means, right? So
And it's like the higher the better, right?
exactly. So there's many ways to
Yeah,
create higher cash flows, right? So one way, when you create higher cash flows, you put less money down, your risk goes up, right? When you put
Yeah.
more money down, your cash on cash goes down, but your risk also goes down,
absolutely.
right?
When it comes to investments, guys, for those of you listening, this is one important term that you got to keep in mind. You got to just ignore a lot of the terms that is in the OM that is presented to you. I mean, there will be some graphs and charts and things that says IRR and ARR and all that stuff. That's all projections. That's all at the end of the exit, maybe 5 years down the line. If all the plan is executed well, that's what you get. But cash on cash is what you got to pay attention to. And this is one reason I like SDRs, because of the higher cash on cash. Although multifamily and other ones perform better over the long term, the short term, the cash on cash is simply how much money, forget about banks and everything. How much money do I have to bring to the table for this deal? And how much money am I going to make in year one? So if I put in $100,000 into a deal, and after everything I get $10,000, that's a 10% cash on cash. Very, very important metric, term that you got to keep in mind is cash on cash, because that's at the end of the day, that's what you're going to get paid every year or every quarter. So a lot of people ignore this. A lot of people don't even know what that is. But one thing that you got to learn is you got to ask them, what is a cash on cash return? May not be always high, but at the end of the day, you're going to be able to know what is your rate of return that you're going to make on the investment on a yearly basis. When I mean, not when the property is operating.
100%.
Cash flow is king, baby.
Well, I
Cash
mean, I
flow is
think
king.
that's pretty good, right, guys, for the night.
Yep, it's great. Let's
Alrighty,
go.
guys. Let's go. Let's go. Let's do it. So, yeah, we are going to be coming to a stop here and going to be landing our plane here for the night. Definitely do tune in next week again. We will be having a new topic based on the comments that we received from the group members, and we'll just keep discussing more and more what you guys want to hear. George, Tom, with that being said, you guys have a good night.
All
You too,
right,
John.
everybody. Have a good night.
Awesome. Great to see you.
All right.